myself Sharmila from the Department of Accounting and Finance. In this video, let's see the basic and conceptual of financial reporting. So what is meant by financial reporting? Financial reporting is the process of disclosing financial information about a company's performance and financial position. It involves gathering, analyzing, summarizing financial data to create comprehensive reports that can be used internal and external stakeholders. Financial reports serve as a communication tool that provides stakeholders such as investors, lenders, employees and regulatory authorities with an understanding of the company's financial health. They offer a snapshot of the organization's financial performance, its assets and liabilities and its overall financial position. So let's move on to the objectives of financial reporting. The objective of financial reporting is to provide relevant and reliable financial information about a company to its stakeholders. Financial reporting serves the following purposes. The first objective is to facilitate decision making. Financial reports provide stakeholders with information that helps them make informed decisions about whether to invest in or lend to a company as well as to evaluate its financial health and performance. Second objective is to communicate financial performance. Financial reports provide a summary of a company's financial performance and position, including its revenue, expenses, assets, liabilities and equity. This information can be used to evaluate a company's profitability, liquidity and solvency. The third one is to building trust with stakeholders. Financial reporting helps build trust with the stakeholders by providing transparent and accurate information about a company's financial activities. This is important for maintaining a positive reputation and attracting investors and customers. Next, let's move on to the types of financial reporting. There are several types of financial reporting that companies use to communicate financial information to their stakeholders. Some of the most common types of financial reporting include financial statements, annual reports, management discussion and analysis, regulatory filings and sustainability reports. So first is financial statements. Financial statements are the most common form of financial reporting. They include the balance sheet, income statement, statement of cash flows and statement of changes in equity. These statements provide a summary of company's financial position, performance, cash flows and changes in equity. The second one is annual reports. Annual reports are comprehensive reports that published annually to provide shareholders and other stakeholders with an overview of the company's financial performance and operations over the past year. The report includes Annual report includes financial statements, a letter from the CEO or chairman and other relevant information. And the third one is management discussion and analysis. The management discussion and analysis is a section of a company's financial report that provides an analysis of the financial statements and other financial information. It includes discussion on trends, then significant events, risks and uncertainties that may affect the company's financial performance. These filings include annual reports, quarterly reports and other filings as required. Next, fourth one is regulatory filings. Companies are required to file financial reports with regulatory bodies such as the Securities and Exchange Commission, that is SEC. Next one is sustainability reports. It provides information on a company's environmental, social and governance performance. They include information on company's sustainability goals, progress and initiatives. Next, let's move on to the benefits of financial reporting. Financial reporting provides several benefits to the company and its stakeholders. First one is transparency. Financial reporting promotes transparency and accountability by providing stakeholders with a timely and accurate information about a company's financial performance and position. This helps build trust and confidence in the company and its management, informed decision making by providing relevant and reliable financial information. Financial reporting helps stakeholders to evaluate a company's financial health and performance, assess risks and opportunities, and make strategic decisions. The second one is compliance. Financial reporting helps companies comply with legal and regulatory requirements by providing accurate and complete financial information in accordance with accounting standards and regulations. Next, third one is investor confidence. Financial reporting helps attract investors by providing transparent and accurate information about a company's financial performance and position. And the next one is performance evaluation. Financial reporting helps companies evaluate their own financial performance and position, identify areas for improvement, and develop strategies to achieve their financial goals. Next is the meaning of users of financial reporting. So, who are all the users of financial reporting? So, users are individuals or groups who rely on financial statements for decision making. They analyze financial information to evaluate performance, profitability, and financial position of the company. Users may be internal users or external users to the organization. So, first one is internal users. So, who are all the internal users? So, internal users are people within the organization who use financial data for planning and control. Management, employees, and owners are the internal users. So, first one is management for strategic planning and policy decisions. So, employees use financial reporting to assess job security and growth opportunities. Then owners use financial reporting to evaluate profitability and business success. And the next one is external users. External users are individuals and institutions outside the organization. Investors, creditors and banks, suppliers are external users. So, investors to decide whether to buy, hold or sell shares. Creditors and banks use to evaluate repayment capacity. Suppliers use financial reporting to determine credit worthiness. And the next one is government and regulatory authorities. Government uses financial reports to assess tax liabilities. Regulatory bodies like SEBI, Securities and Exchange Board of India, ensure compliance with the reporting standards. It helps in framing economic policies and regulations. The other users of financial reporting are customers, researchers and analysts, and general public. Customers use financial reporting to ensure long-term stability of the company. Researchers and analysts use financial reporting for their study and financial forecasting. General public will use financial reporting to understand the company's economic contribution. Next is the financial statements of joint stock company. The financial statement of a company consists of two basic statements such as statement of profit and loss account as well as known as income statement and balance sheet. These two statements have to be prepared on 31st March of every year. As per section 128 of the Companies Act 2013, it is mandatory on the part of all companies to prepare financial statements and present them before the shareholders for their approval at every annual general meeting of the company. So first is the statement of profit and loss. It is otherwise known as income statement. It is a statement that indicates the financial performance of a company by showing net result, that is profit earned or loss incurred during the accounting period. Second one is the balance sheet. Balance sheet is a financial statement that summarizes company's equity, that is shareholders fund, liabilities and assets. And next one is the statement of cash flows. It shows cash inflows and outflows classified by operating, investing and financing activities for the period. It explains how cash and cash equivalents change and why. The next statement is the changes in equity. It shows movements in each component of equity over the period. Share capital, share premium, retained earnings and non-controlling interest. And the next topic is the disclosure. Disclosure is a vital element of financial reporting that ensures transparency, accountability and informed decision making for investors, creditors, regulators and other stakeholders. Indian companies must follow disclosure requirements prescribed under the Companies Act 2013, Accounting Standards, Indian Accounting Standards and SEBI listing regulations. The objectives of disclosure are: it provides true and fair view of financial position, it protects the interest of the investors, it improves corporate governance, it reduces information asymmetry, it helps stakeholders make economic decisions. And next is the regulatory framework for disclosures. Disclosures in India are governed by Companies Act 2013, Accounting Standards or Indian Accounting Standards. Next, third one is SEBI, Securities and Exchange Board of India. So next is the Disclosure under Companies Act 2013. So every company must include, they should have balance sheet, statement of profit and loss, cash flow statement, statement of changes in equity, notes to accounts, auditor's report and director's report. Next is the financial statement analysis. Financial statement analysis is the process of evaluating financial data to understand a company's performance and financial position. It helps stakeholders make informed economic decisions. The objectives of financial statement analysis are to assess profitability and operational efficiency, to evaluate liquidity and solvency position, to understand the financial strength and weaknesses, to assist investors, creditors and management, to support planning, forecasting and control. The importance of financial reporting. Financial analysis enhances the usefulness of financial reports by converting financial data into meaningful insights, improving comparability between periods and firms, supporting transparent reporting, facilitating informed decision making. So it acts as a bridge between financial statements and decision makers. So next is the techniques of financial statement analysis. So major techniques include comparative financial statement, common size financial statement, ratio analysis, cash flow analysis and trend analysis. So first is the comparative financial statements. So comparative financial statement presents financial information for two or more accounting periods in columnar form. It is also known as horizontal analysis. And the second is the common size financial statements. A common size statement expresses each item as a percentage of a base figure. It is also called vertical analysis. And the third is ratio analysis. Ratio analysis is the technique of determining quantitative relationship between financial statement items. It is considered one of the most powerful tools of financial reporting. So the major types of ratios are liquidity ratio, profitability ratio, then solvency ratios and activity ratios. Liquidity ratios measure short-term financial strength, example current ratio. So profitability ratios measure earning capacity of the company. Example of profitability ratios are net profit ratio and return on capital employed. And third one is solvency ratios. It measures long-term stability. Example of solvency ratio is debt equity ratio. Then activity ratios, it measures efficiency in asset utilization. Example of activity ratio is inventory turnover ratio. And the fourth statement is cash flow analysis. Cash flow analysis examines the movement of cash and cash equivalents during an accounting period. It is prepared as per accounting standard to understand actual liquidity of the company. So the next one is trend analysis. Trend analysis involves evaluating financial data over multiple years to identify patterns and long-term direction. It is used extensively in financial reporting for forecasting. In conclusion, financial reporting serves as a cornerstone of effective business management. By providing a comprehensive view of a company's financial health, it enables stakeholders to make informed decisions, facilitates strategic planning, and fosters transparency and accountability. Thank you.